Hi, everyone. This is Joe Gentili from Sarraf Gentile LLP. We're a law firm, and one of the areas that we particularly focus on is representing policyholders in life insurance and annuity disputes. And today I have a couple of tips for people that are in the market or are being sold universal life insurance or index universal life insurance, otherwise known as IULs. So the tips that I have today are first, it's important to keep in mind that unlike other areas of insurance that you're probably very familiar with, like car insurance or homeowners insurance, with permanent life insurance policies, of which universal life is a type of, the cost of insurance and the premium that you pay are not the same thing. So you pay a target premium into the policy, and then the actual cost to provide that insurance for the year is taken out of the premium along with other expenses. And what remains after that goes into your cash value, and then that gets credited in whatever way that you're choosing or whatever type of policy that you have. So the cost of insurance is a component of premium. And in early policy years, it's a relatively small component because it's fairly inexpensive to insure younger people. As you get older, every single year, the cost of insurance increases. And if you're paying the target premium, there's a good chance that at some point in your life, the cost of insurance will exceed the amount of target premium that you have. So this is not a problem if everything works out as planned and cash value increases at a healthy enough pace to offset these cost of insurance increases that come on later in life. But that doesn't always happen for people. Sometimes there's shortfalls. And so there could be a nasty surprise later when you've paid the target premium all along, you get into your senior years and the cash value is getting depleted pretty fast, and at some point may get completely depleted. And you see that the target premium that you're paying doesn't cover the cost of insurance, so you have to pay more premium. And it's more premium every single year. It keeps going up to keep the policy in force. So that's a problem that you'd rather avoid. But it's important to know ahead of time that just because you pay the target premium every year on a universal life insurance policy or an IUL, it doesn't mean that the policy is going to stay in force for life. It could still lapse under that scenario. Of course, there's guaranteed products out there. There's no lapse policies that are sold, but just for regular IUL policies, this is basically how it's set up. Just keep in mind, the premium does not equal the cost of insurance. At some point, the cost of insurance may exceed the amount of premium that you're paying. And if the policy's crediting rates didn't keep up to where they should have been, even though you paid the target premium every year, the policy could still lapse. That's one of the reasons why it's so important to monitor these policies. These aren't set it and forget it items. If the policy is starting to fall behind on cash value, you may have to fund more than target premium early on to try to avoid having this problem later on. So the second issue or second tip I want to give is that the cost of insurance is not guaranteed not to increase. Put another way, the insurer usually reserves the right to raise the cost of insurance on you after you buy the policy, really at any point. So the pricing that you have at the beginning is not guaranteed to stay in place. That's not something that most people are aware of. Um, it's something that used to be sold as, yes, this clause exists in the policies that the cost of insurance is not guaranteed, or it's guaranteed up to some limit, but that limit is really high. But an insurer will never actually, raise the cost of insurance citing this, because if they did that, it would be horrible for their place in the market, and it would be suicide for the insurer's brand. That didn't turn out to be true. Over the past 10 years, a lot of insurance carriers in the universal life space raised the cost of insurance on policyholders on in-force policies. And some of these raises were tremendous. It was double. There were 100% raises on the cost of insurance for some carriers. So when you're factoring in and you're looking at a policy saying, okay, here's the illustrations. What happens if I pay this amount of premium over time and I get this return? Even you should factor in that that may not play out. Even if you have a pretty conservative estimate in terms of crediting as to what you're going to earn in interest on the policies, you have to factor in that at some point the carrier may raise the cost of insurance, in which case, the illustrations that you have are not going to be very useful. It's going to completely change the dynamic of how long the policy stays in force at one funding rate. So keep these two things in mind when you're shopping for universal life insurance or IUL policies. Remember, number one, the cost of insurance's amounts are not guaranteed, or if they are, it's a very, very high guarantee. And the other thing that you want to keep in mind is that premium does not equal cost of insurance. They're not synonymous. And in some cases, the cost of insurance could eventually be higher than the premium. If you have any questions, please feel free to reach out. And if you found this video useful, I hope you subscribe. We'll be doing a lot more on the intersection between law and life insurance. Have a great day. Bye.